Hello and welcome to Business Line. Talk about volatility. In these last few weeks, oil prices went literally on a roller coaster ride. After the infamous Black Monday of the global financial markets, the two main indexes, the European Brent and the US West Texas Intermediate, crumbled, but only to stage a comeback at the start of last week with the biggest 3 days gain in 25 years. Now they seem to have retaken their shaky path, driven in no small part by the performance of the Chinese markets. Apparently, a new causal relationship is being established. Every time the Shanghai Composite Index falls, oil prices follow suit. No surprises there, the world's second biggest economy is also the largest importer of crude oil, and markets are extremely frightened by the prospect of an economic slowdown in the Asian country. Unfortunately, the latest hard data keep confirming these views.
Imports into China fell far more than expected in August, adding to concerns over the effect of the slowdown in the world's second largest economy. Imports fell by just over 14% compared to a year earlier, much more than the drop of around 8% economists had been anticipating. The fall in exports was less than expected, but the sharp decline in imports, particularly noticeable from Europe, reflects both lower world commodity prices and persistently sluggish demand at home. Economists say last month's currency devaluation may help exports eventually, but these figures came too early.
Currency appreciation in the last 12 months is actually putting a lot of pressure on the export sector. Even you adjust the currency, typically we see a lagging period of about 2 quarters to be reflecting the trade data. So from that perspective, I would say export data is probably will continue on the soft side.
The figures left China with a trade surplus of nearly 54 billion euros. Imports of key commodities such as iron ore, crude oil and soybeans all fell. But China's top planning agency has said that rail freight, power usage and the property markets have all improved since last month, indicating the economy may be stabilising. The slowdown has led to predictions that the central bank will have to cut banks' reserve requirements at least 3 more times this year to pump more money into the economy and to counteract the effect of capital outflows as investors move their money elsewhere.
Weaker than expected demand in Asia is just the latest twist in a thriller saga that began last year. The oil plunge started in June 2014 when prices were hovering around $110 a barrel. Since then, Brent crude has more than halved despite a tentative recovery at the beginning of 2015. What's causing this? Well, experts explain the problem is weak fundamentals. In the last decade, global demand was hit by the economic crisis. Supply, on the other hand, grew thanks to techniques such as hydraulic fracturing or fracking, which allows to tap into previously inaccessible shale oil formations. This situation, driven primarily by US producers, led to what experts call an oil glut. Basically, there's more oil in the world than we need. According to International Energy Agency, in the second quarter of 2015, global oversupply reached a staggering 3 million barrels per day. The slide was aggravated by OPEC's decision not to cut output to sustain prices. The Organization of Petroleum Exporting Countries, which pumps 40% of world oil supplies, is following Saudi Arabia. The OPEC's biggest member wants to preserve market share and squeeze high-cost rivals and is pumping crude at record levels to do so. And the oil glut could even worsen after Vienna's nuclear deal over Iran. Tehran's oil minister says the country will restore production, with output rising by 500,000 barrels per day soon after sanctions are lifted. Now, let's focus on the consequences of low oil prices. Unfortunately, when revenues falter, businesses can think of only one thing: cut, cut, cut.
Oil markets are down again amid continued fears over the fall in prices, the glut in global supply and a slowdown in demand in China. The Shanghai Composite Index declined, prompting losses on futures markets in New York and London. Prices are still below $50 a barrel, having fallen more than 25% since this year's peak in June. There are calls for an emergency summit of OPEC heads of state amid fears that the oil producers' organization will be unable to stabilize prices. Oil ministers from OPEC countries meet this week. You have extreme situations like Venezuela and Ecuador, which are really in great difficulty. Meanwhile, petrol companies can't invest. It's simple. And besides, as we've seen, investment is falling all around the world. In a few years' time, we're going to find ourselves in a situation where we can no longer satisfy demand, and at that moment, prices are going to take off.
Et à ce moment-là, les prix vont s'envoler.
5,500 jobs have been lost from Britain's North Sea oil and gas sector since late last year, according to the UK's new energy authority. North Sea operators have all announced cuts. The oil companies have been particularly badly hit by the dramatic slide in Brent crude prices, down by over 50% since June last year. Operating costs are soaring as resources decline. Production is at its lowest level since output started in the 1970s.
So the first consequence is clear. The energy sector is hitting the brakes. According to energy consultancy Wood Mackenzie, conglomerates have shelved $200 billion in spending on new projects. The damage is especially bad in terms of job losses. It is estimated that companies have laid off 70,000 workers worldwide. One of the worst affected countries is Canada, home to Alberta's oil sands industry. Capital spending by the Canadian oil and gas industry will total $34.5 billion this year, 40% less than 2014. Governments of oil exporting countries are feeling the heat too. Venezuela, a country whose crude oil accounts for 96% of export revenues, loses $700 million for every dollar drop in the oil price. Amid slumping revenues, its cash reserves now stand at a 12-year low, according to central bank data. In Russia, oil and gas revenues account for 52% of federal budget revenues and around 70% of total exports. Falls in oil prices drag down the national currency, the ruble, worsening the economic crisis and raising inflation. But wait, because there is good news too. The third consequence is that consumers have experienced lower petrol prices. The average cost in the Eurozone on September 1st was 1.22 euros per liter, while diesel was down at 1.11. According to a report by Capital Economics in May, the positive impact of cheap gasoline is worth more than $200 billion for the US, the Eurozone, UK and Japan. Now that we've seen the consequences of the oil slump, it's time to take a look at the future. What's going to happen to prices? Despite calls from countries like Venezuela, an OPEC intervention does not seem certain, especially since the attempts to coordinate a policy with non-OPEC producers like Russia seem to have failed. Euronews spoke with ADS securities expert Nur Eldin Al-Hamouri. Here's his key takeaway from the current oil market situation.
We have to look at the current situation where fundamentals are unchanged. We know very well we're not replacing oil anytime soon, for a decade at least. World demand is high, and we don't expect a big fall in prices like last year.
That's it for now. Thank you for watching, and we'll see you next week.